Good afternoon. This is Chris Bolter at Val-Chris Investments. Sorry about the late start. We had a few technical difficulties we had to get ironed out. We have Jeff Lamont, President of Val-Chris Investments, joining us today. We have Jake Liddell in charge of investor relations. We have Mayumi Bowers, our Vice President of Operations, and we have Cecilia Mall, who's in charge of our social media and some of this technical support, joining us as well today. We're very happy to have those with us today. We hope you find this informative, and we'll get started. Okay. So I want to start first with a disclaimer. This content is intended for general educational purposes only and does not constitute legal, tax, or investment advice. Foreclosure laws, lien rights, recovery outcomes, and timelines may vary based on the specific loan documents, jurisdiction, borrower circumstances, and other factors. Please consult qualified legal counsel regarding any specific scenario. So now that we got that out of the way, let's dig right in. We've broken our seminar into three different sections, and we'll start with section number 1, dealing primarily with risk, default, and investor protection. And by the way, feel free to send questions. We're going to set aside some time at the end here to answer any questions you may have. And we're also going to tell you about our upcoming investor seminar next month. So let's get started on this. As most of you know, in trust deed investments, there are multiple investor positions or lien positions. Most commonly, we have first trust deeds, second trust deeds, and an occasional third trust deed. In other states, they're oftentimes called mortgages. We call them trust deeds here in California. So let's just kind of separate some of the nuances and differences between the three types of liens that Val-Chris Investments typically originates. First of all, we have first trust deeds. Most commonly, they're considered the lowest risk. They're first in line, has a priority on the property, typically only subject to property taxes not yet due and payable. They're first in line if you ever have to foreclose. They're typically paid before all other liens. Most commonly, from an investor's perspective, they'll have a lower interest rate and a lower yield to the investor. And with that lower return, you get a higher level of safety, generally speaking. Our loan to values typically don't exceed 65%. And most of you who have been buying trust deeds from Val-Chris Investments find that the vast majority are below 60%. Second trust deeds, as the title of the lien describes, it's typically paid after a first trust deed is satisfied. It's in second position on the property, and it's subject typically to the property taxes not yet due and payable and the first trust deed or first mortgage. Generally speaking, they're going to be written at a higher note rate, which means a higher yield to the investors. Most commonly, our combined loan to values are no more than 60%. We do make exceptions from time to time, but again, you'll find the vast majority of our second trust deeds are at or below 60%. Next, and probably the least common, would be third trust deeds. We probably most likely started originating these a little bit more regularly after COVID, and a lot of that came around because people were able to get COVID relief on their mortgages, and many of those mortgage lenders recorded second mortgages to secure those payments that were not made most commonly during the COVID crisis. So they took those payments, recorded them as a second mortgage, and those second mortgages in most cases don't accrue interest. So borrowers don't typically want to pay off a lien that has no interest. So we started originating more third trust deeds after the COVID period, 2020 to 2023, I would say. A quick description here again. They're last to recover at a sale. If there's a first, second, and a third trust deed secured by the property, we offer them very selectively. Typically, they're going to be at lower loan to values, and more commonly, they're going to be behind a first that's a conventional loan, a second trust deed that may very likely be a HUD loan or a loan that was provided by the lender on the first with no interest. So it's actually a nice loan to go behind when it's not accruing any interest. And many of those seconds don't even require payments. What we offer to the investor, of course, is a higher rate of return most commonly on those, and the borrower pays a higher rate on the note or on the loan. And of course, as we share here too, we typically require a higher level of equity before we'll consider a third mortgage. And most commonly, the combined loan to value is not more than 55%. Okay, so let's go through the process here. We'll go through the most unpleasant part of trust deed investments, because I'm a firm believer that when you make a loan, we plan for the best, but we hope for the best, but we plan for the worst. Most commonly, the worst is if we have to foreclose. How does that process start? When does that process occur? Typically, what happens is the borrower misses a payment. Our loan servicing staff will reach out to the borrower. We'll reach out to them. We'll reach out via email. We'll also mail late notices from time to time, and then we'll follow up if we don't get responses from those correspondents, which we do on multiple occasions with a phone call. Assuming we're unable to reach the borrower and get a reasonable reply back that's acceptable to us and you as the investor, we then recommend that a notice of default is filed. A notice of default, when it's filed, it typically in California you have to wait at least 90 days once a notice of default is recorded before you can go to step number 3. Step number 3 is called the notice of sale. The notice of sale is when the trustee, who we use a service for to handle the foreclosure, will publish that particular loan will be auctioned off at typically a public location, most commonly a courthouse or a county recorder's office. They will publish the date when that loan will go to sale, and that period of publication has to be at least for 3 weeks. So most commonly, we use a 21-day period. Once a notice of trustee sale is published, that the property would likely go to sale. If the borrower doesn't cure the loan or pay off the loan during that 120-day approximate period of time, the property goes to a trustee sale. At the trustee sale, it's an auction. It's a private auction. Anybody who wants to qualify can qualify. They have to bring cashier's checks. They show the caller at the trustee sale. They have the cash that would be equal to or greater than the opening bid. And when they do, they're qualified to bid. And the property/loan are sold to the highest bidder. If there is a bidder at the sale, they become the owner. If there isn't a bidder at the sale, then the property reverts and the lender becomes the owner. Now, on the more positive side, let's talk about some of the key investor protections at Val-Chris Investments.
Chris, really quick, there's a couple of questions here. It probably makes sense to answer now since you're
Go right
talking
ahead,
about
Jeff.
it. So rather than wait till the end while we're on the topic, the first one is, are there any additional costs for filing a notice of default?
Yeah, there are foreclosure fees. The foreclosure fees are established by the California Civil Code. They're typically based on the size of the loan. So the California Civil Code dictates what those fees, the maximum fees may be, and that the size of those fees will increase based on the size of the loan. Now, any fees that are advanced, and we're going to cover this under key investor protections, are added to the borrower's obligation, and those advances accrue interest at the note rate until the borrower pays those fees back.
Okay, cool. Next one is, if I hold the junior lien and the holder of the first forecloses and the property goes to sale, to recover my investment, I must bid at the auction the amount of the first and what is owed to me on the junior lien. At the auction, can I use my equity I have in the junior as partial payment of the bid, or do I need to have enough cash to cover the entire bid?
Well, typically, we don't recommend you allow a senior loan to go to sale. If a senior lender has filed a notice of default prior to you recording a notice of default as a junior lender, it's our recommendation that you cure the senior loan so that your trustee would go to sale before the holder of the first. Now, if for whatever reason that doesn't occur and the holder of the first goes to sale before you do, the only way to protect yourself would be to bid the full amount that is being auctioned on the first trust deed. So in other words, if the first trust deed were 500,000 and the opening bid was 500,000, you would have to bid that whole 500,000 if you want to become the owner of the property. Any overage above what's owed to the senior lender would revert to the next lender in line, which in most cases is the second trustee. But to avoid that large of an investment and having to have that much cash, we always recommend that you cure the first to make sure your loan goes to sale before they do.
Okay, so just to clarify his question, nothing from his loan can be used in that event to then get credited towards paying off the senior or bidding on the senior amount.
No, because the
Okay.
senior doesn't, your loan has nothing to do with the obligation of the first mortgage. The first mortgage, they want their cash. Your lien is in second position. So if there's any overage on the first, that overage does go to you, but you don't get any credit at the trustee sale.
Thank you. And the next one, is there a 90-day waiting period for other states as well? That one, it's different by state. So if you were interested in a specific state, just go ahead and email me, jeff@val-chris.com, and we can talk about the specific state you're referring to. All right, go ahead and move forward.
All right, I think we're going to get over to key investor protections. What do we do to make sure that the loan is well secured? First of all, we require title insurance on every single loan that we originate. In fact, we require that the title coverage be equal to 125% of the loan amount. So if the loan is for 100,000, we require $125,000 in coverage. We require ALTA lenders policies on all the loans that we secure, other than loans that are secured by just land. Land title policies are typically CLTA policies, and I won't get into the reasons for that at this point. But we get the most effective title policies we can find to make sure that your loan has the appropriate title insurance. And that secures that the lien that you've purchased is recorded and is insured in the priority that we have referenced and sold you that loan in. The next important part of any of our equity-based loans would be our loan to value. We keep our loan to values typically at 60% on virtually all of our loans, with an occasional exception, more commonly on first trust deeds, where we will go up to 65%. Rarely do we exceed 65% on a first or a second, but the objective is to create enough of an equity buffer so that the borrower, first of all, has a motivation if they can't make their payments to sell the property so that they can keep some of their equity. Or if they can't sell the property, they can refinance the property. So there's enough equity for another lender to pay off your loan. Or in a third case, that there's enough equity when your loan goes to a foreclosure case sale, in worst case scenario, that people will bid on it because the amount owed is less than what the property's owed. So we're a firm believer that equity is a very important part of the underwriting and a key protection for investors. Next would be due diligence. On every loan that we originate, we use independent appraisers, or at the very least, we get what's called a broker price opinion, which would be typically an inspection that's done by a licensed real estate agent. More commonly, BPOs are used on properties that are conforming properties. Most commonly, that would be a condominium or a single-family residential tract home, and most commonly, that would be done on a loan where we believe the loan to value will be at or less than 50% combined loan to value. And you'll find those appraisals or those broker price opinions on every loan, and we certainly recommend you take a look at that before making any investment decision. And as we covered just a few seconds ago with one of the questions Jeff threw at me, any legal fees that are incurred in the collection process are added to the borrower's balance, and those legal fees must be paid back to you as the lender if the borrower intends to keep their property and wants to pay their loan off. So any legal fees that are incurred in advance by the lender are added to your obligation and accrue interest at the note rate until they're paid. Okay, Assembly Bill 130 and what it means to you. Back last year, there was a law that came into effect in California called AB 130. Many of our investors are familiar with it, as is commonly the case when new laws come into effect in the mortgage industry. Many of us get a little bit concerned as to how it will affect our clients and how it will affect us and how we do business. And this is another example of a law that was originated by our lawmakers here in the state of California to deal with what they believe to be a problem in lending. And it was most commonly loans that they called zombie loans or old junior liens. These were liens where borrowers took out loans, and for one reason or another, the lien holder stopped servicing them. They possibly ignored them. They may have written them off. They weren't being serviced properly. This law came into effect as a means of dealing with it. Now, what does it mean to us at Val-Chris Investments and you as an investor with Val-Chris Investments? Frankly, it means very little because the important elements of AB 130, the most important element is that the loan servicer stay in touch with the borrower at least once every 3 years. We at Val-Chris Investments, when we are servicing your loan, there's never any lapse in written contact with the borrower for any 3-year period of time. In fact, most of our loans are written for terms of 3 years or less. When our loans are closed, the borrower is immediately contacted and they're provided payment coupons, payment instructions, and during the entire process, anytime the borrower has any questions, they communicate with us. When a borrower requests a verification of mortgage or they request a payoff, we communicate with them that way. Part of our due diligence in every loan that we originate is we get both the borrower's best phone numbers and we get their best emails, which help us stay in communication with the borrower. So in reality, all that we have to do at Val-Chris Investments is we have to sign a certificate of compliance, which we do if we ever have to foreclose on a borrower. As a client of Val-Chris Investments, you no longer have to worry about AB 130 because we take care of all of the risks and we take care of all the compliance in-house. Okay, let's talk about second trust deeds and why these work for certain borrowers and what they mean to you as investors. Second trust deeds became a bigger portion of our portfolio probably right during the COVID period, 2020 to 2023, 2024, when mortgages were hitting all-time lows or at least lifetime lows for many of us. When homeowners were able to get mortgages in the 2 to 3% range on a regular basis, um, as many of us have discovered, people don't want to pay those mortgages off. So with the fact that they have incredibly low rates, for most people, lifetime lows, the desire to pay those loans off when they need money is something that borrowers like to avoid. Hence, the demand for second trust deeds grew dramatically, and it gave homeowners an opportunity to tap into their liquidity without having to pay off a low interest rate loan. So going down from top to bottom, the next one would be access to equity. Again, borrowers who have equity in their property have become more savvy and they understand the benefit of a blended rate loan. So when they have a large first in comparison to the second, and I'll use the example again of a $500,000 first with a rate of 2 to 3%, and they need to pull $100,000 out of their property for a business or investment purpose, they're very receptive to taking out a second at a rate of 12 to 13% if they can maintain their $500,000 first at a rate of 2 to 3%. So we or their brokers will share with them the concept of a blended rate where you're paying a low rate on the 500 and a higher rate on the 100, which typically would still give them a far better payment, a far lower payment, and a far better blended rate than if we had to do an entirely new first. So that is a big reason why that portion of the market has grown dramatically. Another reason is that second trust deeds are faster and more flexible. Homeowners find that when they go to their bank to pull cash out, and they don't want to touch their first, traditional HELOCs or bank seconds require first a lot more paperwork, a lot more documentation, and they typically take far more than 30 days, more commonly 60 to 90 days to complete. Well, the typical borrower that we see who wants to pull cash out for a business purpose typically is willing to pay for speed. And because we're an equity-based lender and don't require the type of paperwork that a bank does, because we're basing our loans primarily on the equity, the collateral, we can close their loans much quicker. And for many borrowers, paying a little bit more for that simplicity and that turnaround time is far worth it. What does this mean to you as investors? Second trust deeds come with typically much higher interest rates than first trust deeds. So it's an opportunity to earn a little bit more on your money than you would on a first trust deed. More commonly as well, second trust deeds are typically smaller than first trust deeds. So if your investment strategy might be one of diversifying into more loans, second trust deeds might give you an opportunity to do that as well. We still try to keep our loan to values in line with our first trust deeds, typically even a little bit lower than first trust deeds. So seconds typically are a little bit lower because they do have the potential higher risk of having to make advances on the first mortgage. But you get compensated with a higher return on your investment. Okay. Default recovery on junior liens. How is it different than foreclosing on a first trustee? Well, the junior lien can foreclose independently. So it really doesn't matter on the junior lien what's happening on the first trustee. The first trustee may be current. You can still foreclose on the second trustee. But what you have to keep in mind is that if you do foreclose on the second, the first trustee or mortgage doesn't go away. If the property goes to trustee sale, whoever buys the property at that trustee sale and pays your loan off takes that property subject to that first mortgage. If the property should revert, you take that property subject to the first mortgage. So that is one of the risks again in taking second trust deeds versus first trust deeds. One of the positives, however, is that with second trust deeds, you could potentially own a property with a much smaller cash outlay because typically second trust deeds are smaller. But that first trust deed will be there. It'll have to be cured or it'll have to be paid off at some time. Let's go to box number 2. The first lender can also foreclose and it can wipe out your second. And that's what we shared when Jeff had one of the questions from one of our attendees about a first trust deed going to sale before the second. It's very important that when we become notified that the first trustee is not being paid, that we make sure that your loan, if we have to foreclose, goes to sale before the senior loan goes to sale. And the reasoning, as we shared before, is you don't want the first to go to sale and have to rely on an overbid as a means of recovering any money on your second. You also don't want to have to rely on having to cure that entire first trust deed at the sale, which would require you to come up with enough cash to pay off the entire mortgage. Whereas curing that first mortgage would be a far less of an investment and give you that priority of going to sale first. The junior investor recovers again only on the first trust deed sale if there's an overbid. So as a second trust deed lender, you want to be in the driver's seat. You want to make sure that you keep that first trustee current or at least get a big enough jump on that first so that your loan can go to sale first. And again, we want to make sure that there's sufficient equity to protect you as a junior lender if you do need to go to foreclosure and do need to cure that first. Box number 3, the junior lender can reinstate the first to protect its position. And that's what we've been talking about. By law, the senior loan has to accept your reinstatement. So should we become aware that the senior loan is delinquent and it appears there's a possibility they could go to sale before your loan, we're going to request those figures from the senior lender so that you have the option of bringing that loan current to make sure that your loan as a second trustee holder or a third goes to sale before the holder of the first. And that's a very key element if you're going to be purchasing second or third trustees.
Hey, Chris, one
Yeah,
question related to this. When looking at a first trust, or if you're buying a second trust deed and you're looking at a first trust deed, and say the first has a loan modification with a deferred balance, is that deferred balance senior to the second, and is it taken into account when looking at the loan to value?
that deferred balance is senior. You have to look at both. When we see a deferred balance, we look at that and we add the deferred balance to the balance on the first mortgage, excuse me. So we add those up, and you need to look at that as the total encumbrance. Most commonly, you'll find that the deferred balance is not accruing interest, that the lender has added the deferred balance for typically payments that haven't been made by the lender, but they're not charging interest, which is a good thing. But that obligation is senior to your loan.
Okay. Does Val-Chris ensure that the first is paid up to date? I should say any senior loan is paid up to date if we are the second or third trustee?
We make sure that's the case at the time the loan closes. Now we can't provide any assurances after the loan closes that the borrower will continue to keep that first mortgage current. But whenever we become aware that that senior loan happens to fall behind, we do bring that to your attention.
Okay. Is the law for a senior loan to accept my payment from a second position lender a nationwide law, or is it California only?
I can only speak for California.
Yeah. Go ahead and email me, and we can go through the specifics of that one. So, with the person who asked that, feel free to send me an email.
I am confident that Jeff will tell you that any states that we originate second mortgages, and there's only a few that we originate second mortgages, that the rights of a second trustee mortgagee in those states would be equivalent to the rights of a second trustee holder in the state of California, which means you will have the right to reinstate. But Jeff will double check and answer that question for you. Anything else, Jeff?
There's more, but they're not as specific, so we'll do those at the end.
Okay.
So feel free to go.
Okay, last part on this. Recovery time depends on equity in the process. In California, non-judicial trust foreclosure sales are established by the California Civil Code. The process, as we've shared, typically takes 4 months. It's the same process for a junior lender as it is for a first trustee lender or a third trustee lender. All secured mortgages in the state of California who wish to exercise their non-judicial foreclosure option have to follow the same time frame. So once again, it's important that we maintain equity cushion in the property, and we keep that period of time in mind when making a loan. Okay. Um, Section number 2, operation and processes. So let's tell you a little bit about that. The due diligence process. What do we do here at Val-Chris Investments before we present a loan to you? So our due diligence process focuses primarily on the value of the property. That's probably the most important part of the process. So we do our best to get qualified appraisers to give us opinions of value. And again, if the loan to value appears to be very conservative and it's on a more conventional property like a tract home or a condominium, we may use broker price opinions if we believe that the loan to value or combined loan to value will be less than 50%. As shared, we get title insurance on every single loan that we originate. So you'll have title insurance. Borrower verification. If we do a second mortgage or a third mortgage, we will get verification of the existing balance of the senior loan, and we'll get a verification if the loan payments are current at the time of loan origination. If they aren't current, we'll make sure that any delinquencies are paid through the new loan origination. The other important part is that we get confirmation that the loan is for a business or investment purpose. We have multiple disclosures that are required by the borrowers. We take additional steps to confirm that the money is being used for the purposes that the borrower has represented, at least at the time of origination, so that our loan is in compliance with all state and federal regulations. We also get credit reports on all of our borrowers that we can. From time to time, we do make loans to foreign nationals and others who don't have credit reports. That's rare, but it does happen from time to time. Otherwise, we do have credit scores and credit reports on all of our borrowers. We also run background checks on all of our borrowers. If we find something that is a concern, we will bring that to the broker's attention. We'll bring that to an investor's attention. And in some cases, we'll just decline the loan altogether. There are a few other steps we take, but these are the primary steps that we take to make sure your loan is well insured, and we've completed enough due diligence to make sure that the loan is being presented to you properly. Next box to your right, how interest rates are set. Most commonly, we set the interest rates based on the loan to value. There's not a science to this, frankly. It's something that I've been doing for 40 years, and Jeff's going on 15 years of doing this. We get a feel as to what the market is, what our competitors are charging for loans. We look at what conventional rates are. We look at what the margin should be above conventional rates. Most commonly, we're going to find that first trust deeds or mortgages are going to have a lower rate than a second, which would be the same if you went to a bank or another type of conventional or standard institutional lender. The other factors that we look at would be the type of property. Typically, you'll find a higher interest rate on commercial, industrial, or land, or mixed-use properties. Those will typically have higher rates. And then, of course, if you're going to be in second or third position, we typically compensate the additional risks and work involved in a subordinate mortgage with a higher interest rate as well. So most commonly, you'll find that a second will be typically 2 to 3% higher on the rate than a first, and you'll see that a third will be anywhere from 1 to 2% higher than a second on the rate charged to the borrower. Um, Next box, self-funding versus investor funding. AB 130 is one of the laws that if you were doing pardon me, I'm thinking self-servicing, excuse me, I'm getting onto a different topic. Self-funding versus investor funding. We at Val-Chris Investments, we fund virtually all of our loans ourselves. We fund 95 to 99% of the loans ourselves. And the benefit is this of self-funding versus requiring the investor to fund the loan is twofold. First of all, it provides our brokers and our borrowers a high level of confidence that their loan is going to be funded and it's going to be funded on time and it's not going to be delayed for something beyond our control. When we present loans most commonly to our investors, we're prepared to fund the loan and we're not relying upon your funds to fund the loan. It gives us the ability to fund quickly when all the conditions have been met. The other benefit is for you as an investor, we don't need your funds when everybody's ready to close. So should you be out of town, should you have other priorities, should you be on vacation for any reason, you can send your funds in when it's convenient for you, not when we need your funds. Just understand, of course, that you don't start earning interest on your funds until we receive your funds. So our ability to self-fund gives us, we believe, a large edge on most of our competitors because they can't provide that guarantee to their borrowers and brokers that they can have their loans funded immediately upon the borrower or broker meeting all of their conditions, whereas Val-Chris Investments can do that. And we believe that gives you as investors more investment opportunities. Lastly, AI and technology. We have a very young staff here. I'm one of the old dogs here, but we have a lot of young people who are very seasoned in technology and AI. We are constantly keeping ourselves abreast of new technology. We're keeping ourselves up to date in the tools that will allow us to better underwrite our loans and to provide better servicing. And as we become more proficient in these methods and these technologies, we will continue to share them with you as investors so that we can, in turn, help you make better investment decisions. Okay, we'll get down to our last section, miscellaneous. Some of these will be pretty quick. So we'll talk first about investors or people who happen to live outside of the United States. You are not limited to investing with Val-Chris Investments or if you are currently living outside of the United States. The key elements in buying trust deeds is that your funds are being wired from a U.S. bank or through an approved domestic custodian. If you happen to have an address in California or somebody here in California who can do it for you, that's going to make it easiest. But for us to be in compliance, we need to have your funds wired from a U.S. bank. There may be some additional documentation required, but that documentation is relatively easy to complete. And if you happen to be residing outside of the United States and choose to buy trust deeds, you can contact Jake or Jeff, and they'll help you with the additional paperwork that's required to help you stay in compliance with all U.S. Guidelines and allow us to stay in compliance and allow you to continue to buy trust deeds. So feel free to contact our team if you happen to be residing outside of the United States. Second, the future of hard money lending. Frankly, we find that there hasn't been a lot in traditional banking and credit standards over the last few years. I think with some of the shakeups that happened during COVID, with a lot of people taking loan modifications, deferred payments, banks became even tighter in some of their lending criteria and their credit requirements. So with that tightening, we haven't seen much loosening in banking. We expect that the need and the opportunity for business-related finance loans and bridge loans, which we also originated by private money lenders, will continue. We don't expect the market to slow down. In fact, we expect to be growing in 2026, and we hope in the very near future we'll be able to increase our volume, but we don't anticipate any type of slowdown. And we continue to keep on top of any regulatory changes. There's nothing on the horizon that we're aware of right now that would change the future of hard money lending. Lastly, how to increase your deal flow.
I'll talk about this one, Chris, if you
There
want
you
me to.
go. That's your topic, Jeff.
Yeah, so note exchange. It's kind of been a hot topic recently because I realize the change is different, and some of you can buy loans very quickly, apparently, on Note Exchange. We have seen deals being sold in record time. To combat that, we are in the process of adjusting Note Exchange to where when a loan goes live, you'll get to review it, and then you'll click yes, I want it, or you can ignore it. Doing so should allow you, similar to how it was with the mailer, it should allow you about 12 to 14 hours or so to review the deal, and then we'll allocate the loan based on similar to how we were doing it, where people are missing out or you had some deals die on you or getting started, things like that. So I just wanted to say on here with there's a ton of people on here right now. We are aware that some deals are selling extremely quickly and it can be frustrating. So we are addressing that and actively fixing it now. So in about 2 weeks time, hopefully you'll have a different system that it won't be a first come first serve. It'll be based on kind of how we used to run it back when it was a mailer, except now you'll be able to log in, review the deal, have time to do so, and then just say whether or not you want the deal from there, and then we'll allocate it accordingly. All right, Cecilia, would you mind going to the last one for me? Okay, so thank you so much, everyone. One thing I wanted to note too, the event next month. So I know it's been in the marketing emails, but we have Dr. Christopher Thornburg coming to speak. He's an economist. He spoke at our event 2 years ago. He's fantastic. A lot of good information. He speaks at a lot of our industry-wide events. I've seen him speak at the Irvine Chamber events. He speaks all over the place, all over the country. So he's fantastic. I truly hope many of you can come and see him talk. It'll be interesting to see what his outlook is like for 2026 and beyond. I don't even know. So it'll be interesting to kind of get his take on everything to see what he has to say. Regarding AB 130, we have Robert Finley, who's Chief Legal Counsel for the California Mortgage Association. He's going to come and speak as well. He is actually the one leading up the charge against California in AB 130 to get it overturned or at least adjusted for a lot of the lenders that it does affect. So he's there to ask it. He'll be able to answer any specific questions, and he's a wealth of knowledge. So next month's event should be great. It's at the Atrium Hotel. We do have a hotel room block if you want to stay the night. It's literally across the street from John Wayne Airport. So please take a look at that. If you have any questions, reach out to us. We're more than happy to help there.
And
All right.
just as a reminder, it's
Yes.
Wednesday, June 17th at 5:30.
Perfect. Thank you. Yeah, Wednesday, June 17th at 5:30 p.m. If you could make it, that would be great.
They need to
Um,
RSVP too, don't they?
Yes, please RSVP. We do have an active head count. It's all you can eat, and there's drinks and everything. So but we do have a set size. So if you haven't RSVP'd and you're going to make it, please do so we can get an accurate head count. That would be great. All right, let's go through some of these questions really quick. Number one, if the borrower uses loan funds for personal purposes in spite of the business purpose certificate, does the loan risk becoming a consumer loan? Um, Honestly, anyone can claim anything after the loan funds. The due diligence that we do at the beginning, at the origination, is to combat that. So we get them to sign a purpose letter. We have them sign the certificate of business purpose. We now have them put the funds into a business account. On any owner-occupied deals, we're now doing an attorney interview where they actually get a physical video talking to the borrower, having them reiterate what the funds will be used for. So we go through a ton of things now to really document the file to verify that it is a business purpose loan. And in doing so, we believe that it's a pretty airtight when the time comes if they try and claim otherwise. Let's see here. Next one, if foreclosure or delinquent insurance premium is required, who fronts the cash? If it's the lender, what if one of the lenders can't or doesn't want to pay? Chris, you want to take that one?
Sure. That happens from time to time. There's a couple of things we do to help with that. First of all, any advances that are made by the lenders, also there's an advance fee of 3%. So every time you make that advance, you automatically get an additional 3% on the advance. That typically is something that everybody is anxious to get added to their advance on that particular advance. If an investor for some reason is unable to or unwilling to, the first thing we do is we see if any of the other investors will step up to make that advance. In most cases, somebody's willing to because they get the extra 3%. The other key part about advances, what I remind investors is that if you look at our loan servicing agreement, Advances always get paid first. They get paid before the principal gets paid. So you're not you're when you're putting that money up to pay for somebody's insurance or advancing fees for foreclosure or legal fees, those take priority over the actual mortgage itself. So having that assurance, most people are happy to pay it. In those rare instances, there are cases where we have stepped up to do so because I don't mind doing that in many cases because I know the money has priority and I get an extra 3% on my money on top of that. So we haven't had any circumstances where we haven't been able to get it covered by other investors or Val-Chris Investments has stepped up.
Okay, thank you. Let's go to the next one here. What is the loan servicing cost per transaction? We charge 1% to service the loan. It's 1% per year, and it comes out of the borrower's monthly payments. So if the note rate is 11%, then you'll net 10%. As the borrower makes their payment, we take out our split and we ACH you the difference, and we also email you a statement showing that breakdown. I will say 1% is the typical fee. Sometimes it is less or more depending on the deal, but I would say 99% of the time, the servicing cost is 1%. Um, let's see here. We answered that one. We answered that one. I will add to, there's a ton of questions on here, so I'm going through as many as I can. If there's anything overly specific, I'm going to skip those. Just go ahead and email me if you need anything that I missed after this, okay? Next one. We used to have a penalty interest of extra 5% for late payments. I think California took it away. Can you address this? Will it be reinstated? It's a 10% late penalty after 10 days. So it's more than the 5%, and it is still in place. You might be thinking of default interest, which the Hornshaw case in California removed. It can still be charged, but only at maturity due to monetary default, no longer at the end of a missed payment.
Well, I'd like to add that California is the only state that default interest has been determined to be uncollectible except at maturity. So we do have default interest on loans made in some of the other states that we originate. So keep that in mind if you happen to be buying a loan in another state that there may be an opportunity to collect default interest if that's something that might appeal to you. From our perspective, we'd rather see your loans pay on time.
All right, next one. If a notice of default, okay, so if I file a notice of default on a second, what amount is auctioned? Just the amount of the second or also the amount of the first? So this is related to what Chris was saying earlier. When you're in junior position, you really want to take control of the auction and file first before any senior liens. In doing so, you have control of the starting bid. And typically the amount you would set for the starting bid would be everything that's owed to the first plus everything that's owed to you, barring any crazy circumstances. That's usually the route that you want to go. In doing so, if you get a one bid, then it covers everything owed on the first plus everything owed to you as the second. Next one, does filing for bankruptcy by the borrower forestall the sale? And how many times can a borrower use this tactic in California? Chris, I'm going to throw that one to you.
Sure. Yes, if a borrower files for bankruptcy, it's going to certainly stall the process. Most commonly, we find a bankruptcy is filed a day or two before the trustee sale. Even the day of the sale, they'll file a bankruptcy. Again, most commonly, it's going to be a Chapter 13. A Chapter 13 is a reorganization that is typically used as a method for the borrower to buy time. The whole thought process behind a Chapter 13 is to allow the borrower to reorganize their debts and pay off their delinquencies over time. And that does happen from time to time. We actually have borrowers who file a bankruptcy in good faith and make their scheduled payments. We see more often than not, however, it is a stalling tactic. Generally speaking, we find it'll buy a borrower an extra 60 to 90 days before we can get what's called a relief from stay, getting the bankruptcy discharged so that we can go to trustee sale. Your next part of the question is, can they file bankruptcies more than once? Yes, they can. We do our best to discourage that, but it is not terribly unusual to see a borrower file two bankruptcies. Generally speaking, after a second bankruptcy, we're able to get a motion from the courts that allow us to ignore any future bankruptcy. So it's incredibly rare that a borrower would get more than two bankruptcies as a means of stalling a particular trustee sale.
Cool, thank you. Okay, next one here. If a foreclosure and property go to sale for more than the note, if foreclosure and property sales for more than the note who receives the extra proceeds from the lender. basically
I'll deal.
it follows that chain. Go for it,
Yeah,
Chris.
I'll deal with that.
Yeah.
Typically, what happens when a notice of default is filed, the trustee will provide what's called a trustee sale guarantee. It's like a preliminary title report. And what that does is it provides the trustee a list of all the lien holders secured by that property. So whenever a lien holder goes to sale, if there's any proceeds from his sale, the trustee then looks at his trustee sale guarantee and he looks at who is next in line in priority. So the next person in line in priority would get the proceeds. If there's enough proceeds to pay that person in line, if there's anybody second in line behind that person, they would get the balance, and so on and so forth. When all of the secured lenders, according to the TSG, have been paid in full, any proceeds left over would go back to the property owner.
Thank you very much. Let's see, who advances legal fees?
Once again, that's typically going to be advanced by the lenders. That Val-Chris Investments will advance it from time to time. When we do, we will bill the investors for those advances. Reminding again that any advances made are added to the borrower's obligation, and we charge the borrower an advance fee of 3% of the amount advanced.
All right, if the loan goes into default and it has a default rate, are we paid at the default rate? Outside of California, where we charge default interest, typically the default rate is split 50-50 of the amount that Val-Chris receives. Depending on whether or not there's a subservicer in certain states, they will also get a portion of it. So that's why I say it's based on the amount that we receive. Does VCI track whether insurance is being kept paid? So we are aware if insurance is paid. If they apply for modification, we'll then check to make sure insurance is current. If we get a cancellation that the property has the insurance is canceled, that's when we'll notify you and go and get force placement and coverage. So assuming we're notified or assuming the borrower is contacting us for some sort of change or modification, that's when we're looking to see if the insurance is up to date at that time. Is the business purpose portion of due diligence considered satisfied if the borrower handwrites the statement, or should we look for other information on the Secretary of State and business license, et cetera? So I kind of went into this earlier. We have a full list of stuff we do to verify the business purpose on there. You are more than welcome to go to anywhere to further check anything above and beyond that as well during your due diligence. If I purchase a second trust deed, do I need to keep liquid cash on hand to pay off the first just in case of a foreclosure? Again, it depends on the situation. We always say you should be in taking control of the foreclosure and going first. Meaning filing first. Whether that means reinstating the first, maybe you're debt servicing it in the interim during the 90-day waiting period or the 20-day period after that. So you don't need the cash to pay off the loan in its entirety. That'll happen if the property goes to sale and someone bids and your amount covers that first, then that's when they would get paid off. Next one, how long do I have to cure the first? So that's a general question. Give me a call on that one and we can kind of talk through different scenarios that would depend on that one.
Well, keep in mind that you can cure the lender up by law. They have to accept your reinstatement up until 5 days prior to their actual scheduled trustee sale. So you can cure it at any time up until that point. So our objective, whenever we find out that a senior lender is delinquent, is we want that loan cured before you even get remotely close to a sale date. But by law, they have to accept it up until 5 days prior. Then it's their option.
Okay. On a loan that matures, is there a legal period of time that a lender must formally extend the loan?
No, there is not.
No. If the loan matures, then the loan matured. Now you can extend it if you want to. That's just the conversation to modify the note and get a new maturity date. But otherwise, no. Difference between judicial and non-judicial foreclosures within California and outside. That can be a full webinar on its own. I would say give me a call on that one. We can go through the differences. Each state can be a bit different as well, depending on the waiting periods, whether or not there's multiple bites at the apple, things like that.
Yeah, I'll give you just a quick one sentence. The big difference is that with a judicial foreclosure, you're basically filing a lawsuit.
Yeah.
So it's going to cost you more money in legal fees and it's going to take longer. But
Yeah,
there may be some benefits with a judicial foreclosure, just depending on the circumstances.
Yeah, I mean, a judicial can take longer. I mean, I think on average we see in Florida it's like what 9 to 11 months, depending on the deal itself. There is a full lawsuit involved. You do have an attorney. But however, it does offer benefits. You can go after what's called a deficiency judgment if you're worried about not being enough equity to bring it current, or you thought there was fraud involved, things like that. So there's a lot of stuff there. So yeah, we can go through specifics. I already covered this one. What about a due on sale clause with first? Okay, so that one was done. On a prelim, we sometimes see the borrower's name may have recorded liens and judgments that are not attached to the property. Do those judgments act senior to our loan?
They do not. But I mean, that's what your title insurance is all
Correct.
about.
Yeah.
The title insurance is designed to provide you insurance, basically, that the lien that you have purchased is in the priority that has been represented by the title company.
Next one, what are the differences in foreclosure process for owner-occupied versus non-owner occupied loans? In California, if we're looking at a non-judicial business purpose loan, there really aren't any major differences when it comes to the timeline. The difference mainly lies whether or not a loan is for consumer or non-consumer reasons. If you're in consumer guidelines, then you're following homeowner bill of rights, and it can take longer. When it comes to business purpose loans, though, whether you're doing owner or non-owner occupied, roughly the same timeline applies. Uh, let's see here. As a holder of Val-Chris trustee and I want to cash out, what is the process? The process is reaching out to us and just letting us know, and then we can look to see if anyone is interested in buying out your portion. We probably do that a couple times a year. I will tell you there is a chance that no one wants to buy you out, depending on the loan. Loans that could be delinquent or on less on more rural properties, unique properties might be harder to get bought out, and you might need to take a discount on that as well. Do all loans carry a 6-month prepayment penalty? No, they do not. Some have none, some have 6 months. It really depends on the deal itself, and that's part of the pricing process that Chris or myself review and determine at the time the loan is priced. Let's see. Can a borrower's IRS lien trump a deed?
What was that? One more time, Jeff?
Can a borrower IRS lien trump a deed lien?
No. I mean, again, the IRS has no additional protections than any other lien holder, other than the IRS has the right to redeem a property. So if the IRS doesn't record their lien before our lien is recorded, they're in a junior position. If you go to trustee sale and the property reverts to you, the IRS has a right of redemption. I haven't seen one in a long time. I can't recall if it's 90 days or 120 days, but they don't get priority over your lien unless they recorded their lien before our lien was recorded. If that should occur, we would typically pay it off. The only time we wouldn't pay it off would be if the title company missed it.
All right. Do bridge loans generate a higher return? Are bridge loans part of the note exchange? Uh, the loan return is going to be dependent on the loan to value and the deal specifically. So it
Yeah,
could have,
yeah.
but
I would say most commonly bridge loans will have a little higher rate because bridge loans don't have prepayment penalties on them. So because they don't have prepayment penalties, more commonly they're going to have a higher rate. And their bridge loans are typically written for 11 months.
okay. Let's see. Will the recording of the seminar be available? I'm assuming they're referring to the seminar next month. Cecilia, are we recording that or Mayumi?
Both are being recorded.
Okay, cool. When will Val-Chris start to service Arizona or Texas loans? So we do service Texas. We do not service Arizona. We use a sub-servicer for that. As of right now, that's going to be remaining as is. But if you want to avoid a sub-servicer, then California and Texas is the way to go. Let's see here. Sometimes I just want a short-term loan investment, roughly 6 to 12 months. Often borrowers only seek a quick loan and intend to pay off the hard money for a conventional loan in a couple of months. Is there any way the investor gets the estimate of the shorter loan timeline? I would say no. The only thing that's going to help you there is look for loans that are 12 months in the term, in the initial time. That's usually as short as we'll go. So if you see a 12-month term, then you know that it's going to be most likely a shorter timeline.
Or if it has no prepayment penalty. Typically, a borrower is going to pay a higher rate to buy out the prepay. So if you see a loan with no prepayment penalty and it's got an unusually high rate, that's likely somebody who's very confident they can pay the loan back in a short period.
Okay. What about the difficulty of foreclosing on non-trustee states? How long does it take customarily? Okay, so I addressed that earlier. with the judicial versus non-judicial. As a lender, if I need cash, can I assign my interest in a multi-lender loan to another person? I also address that. Yes, you can sell off your portion of a loan to someone else. Let's see here. Chris, someone said that correct that what I said about the amount of the opening bid on a junior lien. I implied that the amount of the senior lien is added to my bid. That is not true.
It may have sounded that way. The senior loan has nothing to do with your bid on a second. If you hold a second trust deed, anybody who buys your trust deed at a trustee sale, they assume they don't assume. They take the property subject to the senior mortgage, so it doesn't go away. But your bid, when you're opening your bid on a junior lien, does not include anything on the first mortgage,
Thank you.
other than maybe advances you might have made on it.
Okay. Someone's asking if they can get a copy of the slides. If you're interested in a copy of the slides, please email me. Same question, copy of the slides. Is the meeting recorded? I believe this is being recorded, right? You said
Yes.
that was? Yes, okay. Is it easy to cash out on a performing loan? I think that helps, definitely. It would require, though, that someone's interested in buying out that loan as well. So it's just a matter of finding the right buyer. Just reach out to us if you want to get purchased, or if you want to sell a piece of your deal or one of your loans, and we'll look at it from there. Someone's asking if it's more common for a first or a second to go to foreclosure. I think they're pretty even. I mean, Chris, do you see first or seconds going to foreclosure more than others?
Well, I mean, what was the question again?
If it's more likely for a first or a second to go to foreclosure.
I would say a second's more likely, generally speaking. I mean,
Okay.
we certainly if you're looking for a percentage of loans that go into default, second trustees go into default more commonly than first.
Thank you. Another one just came in. Are borrowers on owner-occ loans protected from lenders assuming ownership of the property if the borrower's primary residence? No. So that was the owner versus non-owner occupancy I referred to earlier. The timeline is generally the same. Let's see here. Okay, everyone. Thank you so much. There's a bunch more here, so I'll have to cut this off. But if you have anything else that you would like to address or have a conversation with, feel free to reach out to me. We've been going for about an hour. I want to make sure I'm sensitive to everyone's time here. So thank you for your time. Please reach out with any questions. Chris, you have anything you want to add before we go?
I believe they have those who want to attend our seminar next month, our investor appreciation dinner. I believe you can send questions that we'll try to share with the attorney panel and with our speaker. So if you have any questions that Jeff or myself haven't been able to answer, you can send those to us as well, and we'll see if they can be handled by our panels.
Perfect. Thank you so much, everyone. I appreciate your time.
Thank you. Have a great afternoon.